Welcome back, James.
Thanks, Chris.
We've been watching this dollar dead cat bounce. What do you see happening with the U.S. dollar?
I think you're calling it a dead cat bounce was very accurate. The dollar's been in a decline all decade long. We went to a new record low last July, based on the dollar index, which is a composition of several different currencies, which to measure the dollar's exchange value. We had a little bit of a bounce, and then it just started rolling over. And this year it's been basically pretty much downhill. When it broke support back a couple of months ago, it went down quickly, and we're now back down below 80 again, which has been sort of a critical support. We're threatening to take the dollar's old lows out and make new lows. I think the market is giving us an important message, avoid the dollar, which is basically what I've been saying all along, and hold precious metals instead.
You've also been watching this battle royale unfold in the U.S. Treasury market. And over the past few months, the long bond particularly, has been just decimated. And you've talked about how the collapse of Lehman Brothers, that almost 50-year-old institution that began in Alabama and became a Wall Street icon, the Treasury Department and the Fed let that company go down in flames. With yields going up high, this situation bodes not so well for the U.S. dollar.
Exactly. The Federal Reserve last March said that they're going to be buying U.S. government paper and of various sorts, $1.8 trillion before the end of the year. And since then, yields have been climbing rapidly. They've backed off the last couple of weeks, but the trend is clearly up since that announcement. And this has sort of surprised people because they were saying that, well, if the Federal Reserve is buying government paper, yields should decline, not rise. But my point is that because the Federal Reserve is buying paper, yields are rising, which is precisely accurate, because what the Federal Reserve is doing is they're monetizing all of this debt, and that's highly inflationary. And in a highly inflationary environment, one would expect higher yields. So my view is that we're moving toward inflation and actually hyperinflation, and rising yields here are just another indication, more writing on the wall that we have a very inflationary future to face.
I spoke with Jim Rogers in Singapore last week, and from his perspective, the U.S. Treasury is the last real bubble out there. Since we've talked, some of the air has been let obviously out of that bubble, but he would agree that we still may have further downside to go. Do you believe that the long bond was one of these almost housing-like bubbles? There still could be considerable downside ahead?
Yeah, I do believe it was a bubble. Last year when everybody was seeking safety after the collapse of Lehman Brothers particularly, but pretty much during the whole course of the year as the subprime problem was not contained, contrary to what government leaders were telling us at the time, that people were seeking safety for their assets. A lot of money went into gold and silver for that reason, and then also a lot of money went into Treasury bonds, and Treasury bills, thinking that was a safe haven. Interestingly, even though the stock market continued to decline in March, yields had already started rising on T-bonds, which was suggesting that people were not looking at the safe haven status anymore. They were looking instead at the potential inflationary risks and demanding higher yields. So, yes, I think the Treasury market has a bubble mentality attached to it, but it's, in my mind, not the last bubble. The last bubble is the U.S. dollar, and that one really is not yet popped. People still accept the dollar thinking that it has value rather than just, hollow promises of a government that's never going to make good on all of its financial commitments, and as a consequence, the dollar is going to collapse. At some point in time, we're going to reach the tipping point. We may almost be there when people just lose confidence in the dollar and the value of it disappears very quickly over, say, a six-month period of time. But the dollar, in my mind, is the last bubble, and it's eventually going to pop as well.
Exactly. When we look at the long-term trend, it certainly is down. This has been going on for much of the past decade.
It's been going on for a century. Created in 1913, the dollar then compared to the dollar today, you only have less than 5 cents of the purchasing power of a 1913 dollar. So it's been a long-term decline. There's this gradual erosion of purchasing power, but that will accelerate. But eventually what will happen is people will lose confidence in a fiat currency that's backed by nothing except government promises.
Well over 95% loss in purchasing power. And of course, I'm just referring to the basket of global currencies, since, of course, they've been inflated away as well. I guess if we look at their lost purchasing power relative to the dollar, that's all I was referring to.
Yeah, that's actually a good point, because in a world of floating currencies, all of the currencies bob up and down relative to each other in any given year. But they're all sinking relative to gold, which is the important point. Gold preserves purchasing power over long periods of time. Fiat currencies lose it over long periods of time. And you're supposed to get interest income on your fiat currency in order to offset the risks of inflation and the risks of loss of purchasing power. But with the Fed pursuing a zero interest rate policy, in fact, central banks around the world doing the same thing with essentially zero interest rates, there's not any incentive to hold fiat currency as opposed to holding precious metals.
So you might say then that in the kingdom of inflation, the one-eyed currency was king, and that was the greenback. I'd like to address the inflation situation. You've talked about hyperinflation as these central banks buy up U.S. bonds, particularly the U.S. Central Bank, and monetize the debt. And now they're using terms like quantitative easing and a different name on the same story. Would you mind telling folks exactly what the Fed and the Treasury are doing behind the scenes?
Yeah, quantitative easing is just a fancy name for printing money, or, in today's world, creating electronic bookkeeping units of account. You really have to distinguish between money on the one hand and currency. Money is this mental tool that we use for economic calculation, and currency is what we actually use day to day. And there are basically two kinds of currency. There's the cash currency we carry around in our pockets, and there's the electronic currency that appears on our bank statement, and it moves around in commerce by checks, wire transfers, plastic cards, those types of things. And what the Fed is essentially doing is by buying government paper, they're creating more electronic units of account. And that's how we're ultimately going to go into hyperinflation. It's not going to be a hyperinflation like Weimar Germany or Zimbabwe today, where most people in those countries did not have bank accounts, and most commerce was conducted with paper currency rather than bank currency. It's going to be a hyperinflation like Argentina back in the early 1990s. Everybody in Argentina had a bank account. Cash wasn't that important in terms of the overall conducting of commerce. And what the Central Bank of Argentina did is they just kept buying government paper, putting electronic units of account in the government's checking account, and that's how the money got spent, and it led to a hyperinflation. That's the type of hyperinflation I'm expecting to have happen here in the U.S., because the amount of money that the government is borrowing to meet these completely outrageous spending aspirations that it has is essentially greater than the market can absorb. It's greater than world savings. In that kind of environment, they can only print, or in this case, electronically bookkeep these new units of account, and that's going to be a hyperinflationary outcome for the U.S. dollar. My expectation has been it's going to be clear by the end of the year, first quarter of next year at the latest. I'm sticking to that forecast.